Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from PPG Industries, a company known for making paints, coatings, and specialty materials. It sounds kind of boring, right? But stick around because hidden in this report are details about a big money move that could impact the company's future. Think of it as trying to figure out if someone is actually good with money or just really good at pretending to be. This report, filed on February 26, 2025, is about a significant event. PPG took out a huge loan, almost $1 billion in euros. So what exactly did PPG do? Well, on March 4, 2025, they finished selling what are called notes worth 900 million euros. Think of these notes as IOUs, promising to pay back the money with interest later on. It's like taking out a massive loan from investors. To do this, PPG followed a process that involved filing paperwork with the Securities and Exchange Commission, or SEC, back in 2023. They updated this paperwork with more details in February of 2025, kind of like adding extra pages to a contract. These notes were issued under an agreement called an indenture with the Bank of New York Mellon Trust Company acting as the middleman. This agreement, which has been updated a few times since 2008, includes rules that PPG has to follow. It's like the fine print that says what PPG can and can't do with this money. These rules limit PPG's ability to take on too much debt, merge with another company under certain conditions, or sell off most of its stuff. It's a way to protect the investors who loaned PPG the money, making sure PPG doesn't do anything too risky that would make it hard to pay them back. There's also a clause about what happens if there's a big change in who controls PPG. If this happens, PPG might have to buy back the notes at a slightly higher price, which is 101% of what they are worth, plus any unpaid interest. This is to protect the investors if the company gets sold or changes hands. PPG can also pay off these notes early if the tax laws in the United States change. If this happens, they pay back the full amount plus any interest owed. PPG plans to use the money they raised for general business needs. This could include things like paying for day-to-day operations, investing in new equipment, giving loans to their own smaller companies, paying off existing debts, or even buying other companies. So it's a bit of a vague outline, but they have a lot of options. If you want to dig into the fine print, all these agreements and the details of the notes are available as exhibits or attachments to this report. You can find the original agreement from 2008 and the updates filed with the SEC. There is also a legal opinion from PPG's lawyers about whether these notes are valid. All this information is publicly available for anyone who wants to read it. This section is mostly a repeat of what was already mentioned, confirming that PPG has taken on this financial obligation. On February 26, 2025, PPG made a deal with a group of underwriters, which are essentially banks that help sell these notes to investors. PPG agreed to sell the notes to these underwriters, who would then offer them to the public. The underwriters bought the notes from PPG at a slightly discounted price, which is about 99% of their full value, and then planned to sell them to the public at a slightly higher price, about 99.4% of their full value. The difference is how they make their money. PPG also agreed to protect these underwriters from certain legal risks, including potential issues under the Securities Act, and to help cover any costs if they get sued. Finally, the report lists all the documents attached as exhibits, including the underwriting agreement and legal opinions. You can review the full underwriting agreement and other related documents to understand all the details. So what does all this mean for PPG? Well, taking on 900 million euros in debt is a big move. It gives them a lot of financial flexibility to invest in their business, pay off old debts, or even buy other companies. But it also means they have to pay back this money with interest, which can be a burden if things don't go as planned. The rules in the agreement, or indenture, also limit what PPG can do with its assets, which could restrict their options in the future. Looking at the numbers, PPG's success will depend on how well they use this money. If they can invest it wisely and grow their business, the debt could be a smart move. But if they make poor investments or face unexpected challenges, the debt could become a problem. One potential risk is the global economy. If there's a slowdown, it could hurt PPG's sales and make it harder to pay back the debt. Another risk is competition. The paints, coatings, and specialty materials industries are competitive, and PPG needs to stay ahead of the game to maintain its market position. Overall, this debt offering is a bet on PPG's future. They're betting they can use this money to grow and create value for their shareholders. Whether that bet pays off remains to be seen. This big financial move puts PPG at a crossroads, and how they navigate it will determine their success in the coming years. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.